studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
This slide introduces an important exception to many of the salary versus dividend discussions we have covered so far. In most situations, we compare salary and dividends based on factors such as CPP, RRSP, cash flow, retirement planning, and administrative cost. However, certain industries have an additional consideration. In these industries, salary can generate valuable government tax credits. That means salary is not simply a compensation expense. It may also unlock government incentives that create significant tax savings or even cash refunds. On the left side of the slide, we see a company conducting research and development activities. This represents the SR&ED program, which stands for Scientific Research and Experimental Development. The SR&ED program is designed to encourage innovation in Canada by providing tax incentives for eligible research and development work. One of the major components of many SR&ED claims is eligible labor expenditure. In other words, salaries paid to employees involved in qualifying research activities may help generate valuable tax credits. Now look at the right side of the slide. Here we see the film, television, and digital media industries. Many provinces and federal programs provide tax credits for eligible production activities. These incentives often rely heavily on labor expenditures as part of the credit calculation. Production staff, creative teams, developers, animators, editors, and other employees may all contribute to the eligible labor costs that help generate tax credits. At the center of the slide, we see the complete process. The company pays salary. Those salaries become eligible labor costs. Eligible labor costs are used in tax credit calculations. The company then receives tax savings, refundable credits, or direct cash refunds. This creates an important planning insight. A salary payment may not be as expensive as it initially appears. While salary creates payroll costs, CPP contributions, and administrative obligations, it may also generate valuable government incentives that offset part of that cost. This is why advisors must look beyond the salary expense itself and consider the broader economic impact. A salary dollar may be helping the company qualify for benefits that would otherwise be unavailable. The key lesson from this slide is simple. In certain industries, salary does more than compensate employees. It can unlock valuable government incentives. Whenever a company is involved in research and development, film production, television production, animation, digital media, or similar activities, compensation planning should include a careful review of available tax credit programs. Before deciding that dividends are preferable, advisors should first determine whether salary payments are generating tax credits that could significantly improve the company's overall financial position. Sometimes the value of those credits can be substantial enough to completely change the salary versus dividend analysis. This slide highlights one of the most important mistakes that can occur when comparing salary and dividends. Many owner-managers focus on reducing CPP contributions, payroll costs, or administrative work by replacing salary with dividends. However, in companies that qualify for government incentive programs, that decision can sometimes reduce valuable tax credits. In certain situations, the savings achieved by avoiding salary may be far smaller than the incentives that are lost. Let's begin with the left side of the slide. This is the salary route. When salary is paid to employees performing eligible work, those salary expenses often become eligible labor costs. Those labor costs can then be included in programs such as SR&ED claims. film production credits, digital media credits, or other government incentive programs. As a result, the company may receive larger tax credits, larger refunds, or greater tax savings. Notice the flow. Salary is paid. The salary becomes an eligible labor expense. That labor expense is included in the tax credit calculation. And ultimately, the company receives a government refund or tax benefit. This creates a powerful financial advantage. Now let's look at the right side of the slide. This is the dividend route. When compensation is paid as dividends, the payment is generally not treated as an eligible labor expense. As a result, those amounts are usually excluded from many tax credit calculations. The company may then report lower eligible expenditures, resulting in smaller tax credit claims and smaller refunds. The key point is that dividends may save payroll costs while simultaneously reducing government incentives. This is why the advisor shown in the center of the slide is carefully comparing two different strategies. In one scenario, salary generates a larger tax credit. In the other scenario, dividends reduce the eligible labor costs and produce a smaller claim. This leads to the important question shown at the center of the slide. Could saving CPP cost more in lost tax credits? In some cases, the answer is yes. A company might save a few $1,000s in CPP or payroll-related costs, but lose a much larger amount in refundable tax credits or government incentives. That is why compensation planning should never focus on payroll costs alone. The analysis must consider the entire economic impact. The warning banner at the bottom captures the key lesson perfectly. Always review incentive programs before choosing dividends over salary. Whenever a company participates in research and development, film production, television production, animation, software development, digital media projects, or other incentive-based industries, the advisor should first determine how compensation choices affect the available credits. The best compensation strategy is not necessarily the one with the lowest payroll costs. It is the one that produces the best overall after-tax and after-credit result. Sometimes salary may appear more expensive on the surface, but once tax credits are included, it can actually become the more profitable option. That is why incentive programs must always be part of the salary versus dividend analysis. This final slide brings together the practical planning process that advisors should follow whenever government incentive programs may be affected by compensation decisions. The most important lesson is simple. Never evaluate salary and dividends in isolation. Instead, evaluate them within the context of all available tax credits, incentives, and government programs. Let's begin with the left side of the slide. This represents good planning. The company pays salary. That salary becomes an eligible labor expense. Those labor expenses contribute to SR&ED claims, media tax credits, film incentives, digital media programs, or other government-sponsored tax credit opportunities. As a result, the company receives tax savings, refundable credits, or direct refunds. When those benefits are taken into account, the true economic cost of paying salary may be much lower than it first appears. In some cases, salary can actually become the more profitable option after considering the available incentives. Now compare that to the right side of the slide. This represents poor planning. The company pays dividends instead of salary. Because dividends are generally not eligible labor expenses, they often do not qualify for these incentive programs. As a result, valuable tax credits may be lost. The company receives smaller refunds, lower tax savings, and reduced government support. What initially looked like a payroll cost saving can sometimes become a much larger economic loss. That is why the advisor shown in the center of the slide is using a detailed planning checklist. Before making compensation decisions, the advisor asks important questions. Does the company perform research and development? Is the company claiming SR&ED credits? Does it qualify for film, television, animation, digital media, or other industry-specific incentives? Are salary costs included in the tax credit calculation? Would replacing salary with dividends reduce the claim? And most importantly, what is the final after-credit result? Notice the formula shown in the center of the slide. Salary cost minus tax credit benefits equals the true economic cost. This formula changes the entire analysis. Many people look only at the salary cost. Professional advisors look at the after-credit cost. Those are often very different numbers. The examples listed at the bottom of the slide illustrate where this issue commonly arises. Research and technology companies, film and television productions, digital media businesses, animation studios, software and video game developers, creative production companies. In all of these industries, compensation decisions can directly influence available tax credits. This leads us to the key takeaway from the entire section. A salary payment may trigger tax credits that are worth far more than the CPP contributions or payroll costs associated with that salary. That is why advisors should never focus solely on minimizing payroll expenses. Instead, they should evaluate the complete financial picture and determine which compensation strategy produces the best overall economic result after considering all available incentives. Sometimes the smartest tax planning decision is not the one that minimizes salary. It is the one that maximizes the company's overall after-tax and after-credit outcome.